Coming up today, stocks continue to dip. A look at valuation and earnings. A small cap still a buy here. Alibaba rips up on a robot deal with NVDA. Besant says we should get more rate cuts. Is Jay Powell right on the stock market? And did we just get a signal similar to December 1996? You're going to enjoy this one, guys. Let's go. Hey, what's up, guys? Hope you're doing well out there. Another interesting day on Wall Street. Looking at the heat map, we're a little mixed. As usual, we do have a few things going on underneath the hood, all of which I'm going to share with you today. And stick with me because later on, I'll show you what happened that is actually very similar to something that happened in December 1996. Plus, I've also got good news for British and European investors looking to follow my new ETF portfolio service, due out this time tomorrow. So stick around for that, as I'll also be sharing some interesting new ETFs that have just come onto the market, along with the best performing ETFs from today, which are showing some significant moves, in particular industries out there that are unrelated to AI and tech. But before we get into all of that, let's just take a quick look at the market, the big headlines from today, and where we currently stand overall. So another bit of a pullback here, looking at the S&P 500, only off 1/3%, and it's still been months and months ever since we've had a 2% down day, even back here on the 1st of August. SPY was only down 1.64%. But is that late September seasonality finally playing out? Here we are on the 24th, market's usually down, just like it was yesterday. History suggests the rest of the week could see a little softness as well, before we actually get into a typically bullish first week or two of October. And just like September, we can also see a bit of late month volatility in October. Before November and December are usually two of the best months of the year. We did have that divergence of late between the VIX and the market, with volatility perking up, but it appears to have paused today, with the VIX still really low at 16, implying the market should be moving on average 1% up or down for the next few weeks. But we did just make an all-time high in the S&P 500 in the normally bearish month of September, and that typically bodes well for Q4 returns as we kick off Q4 next week. Whenever we've hit a new high in September, 90% of the time Q4 finishes higher, coming off the back of this amazing momentum in market. In fact, we're on a 5-month winning streak. Again, that persistent momentum bodes well for future returns. Whenever the S&P's done that, we're higher a year later 93% of the time. And so things are definitely in motion here, not just in US stocks, but international stocks, commodities, and cryptos overall, even though they're still having a little bit of a pullback this week. And so looking back the last 100 years, the S&P averages about 7.8% a year, but most years are anything but that average. When the market is higher, it's typically higher well into double digits. Just like when it's lower by double digits. And so the S&P is currently up a bit over 12% year to date, suggesting we could have potentially a bit more room to run and maybe slap on another 5% or so in Q4. No doubt the stock market isn't cheap, especially looking at traditional valuation metrics. Keep in mind though, valuations are not a good timing tools in the short term. Just looking at a scatter plot here of the S&P 500's trailing PE ratio versus the performance a year later. There's no real correlation. In fact, you can see most of the time when the market is richly valued, PEs above 25, the returns a year later can often be performance and sometimes massively so. Likewise, when the market's cheap, it can keep getting cheaper the next year. Looking back in history, these high valuations don't bode well for forward 10-year returns. And we still have a massive gap between the States and the rest of the world. History would suggest the rest of the world catches up over the next 10 years. But for the here and now, the market could very well melt up for another year or two. Just looking at this chart here, in the pink, the year-over-year growth in price earnings, valuation multiples. You could kind of think of that as how enthusiastic investors are to own stocks. In the blue, earnings per share growth. Where we currently stand, earnings has actually been growing faster than multiples this year. So that's a sign of a healthy bull market and very much different from what we saw in 2020. Earnings were actually contracting, but we saw a massive expansion of multiples. Investors getting very enthusiastic to own stocks, and that was a big liquidity-driven bounce thanks to Fed and government stimulus. So again, this chart shows we could have further to go. If investors get really excited about owning stocks, we could see a much bigger expansion in multiples. Because remember, stock prices have to go up just to retain the same multiple when earnings are growing. And so when you get earnings growth and multiple growth, that's when you get those big outsized moves. And the party could still be just getting started. We've got a very pro-business and pro-market administration and regulatory agencies, the Securities and Exchange Commission, not only opening the door for crypto, but also now looking to remove the long-standing $25,000 minimum equity rule for day trading, which states that an investor must have at least $25,000 in their account to make 4 or more day trades within a 5 business day period. And that was put in place after the last tech bubble in the early 2000s to protect small investors, because if their account went below $25,000, they couldn't make any more day trades. But that's been a very controversial rule that's set to be overhauled. No doubt that's going to be a huge boost for brokers like Robinhood, market makers like Citadel, and the overall stock market. My regular viewers know I've never recommended day trading And that's because it's been well and truly proven that over 95% of retail investors lose at day trading. Whatever you think you see, the algos see it way faster. And I know there's plenty on here that promote day trading, trying to sell expensive courses and whatnot, but they don't back that up with any evidence or proof that they actually successfully day trade themselves. But no doubt, kind of turns the stock market into a casino and very exciting and appealing to many small investors out there. Me personally, I don't like being glued to the screens all day. I prefer to either swing trade with options or actively invest in small cap stocks and ETFs. And we've actually had a big run up in small caps of late, starting to catch up to large caps. Some out there wondering whether it's too late to jump on board small caps. In my opinion, I still think it's early days, as we've got multiple tailwinds. Not only a record valuation gap with large caps, but looking back in history, whenever the Fed starts cutting rate, small caps can significantly outperform, especially looking at a year or two. In fact, almost doubling the average price return of large caps after we get a Fed rate cut. In addition to that, small cap earnings growth is expected to not only catch up, but overtake large caps come Q4 this year and keep accelerating into 2026 next year. No doubt risks remain, plenty of weakness in the jobs market, and always those geopolitical tail risks in the background. But wouldn't it just surprise all of us if the jobs market actually started coming back? Got the latest forecast from Goldman Sachs. They think the jobs market's about to bottom and we're going to see job growth going into next year. In addition to some other positive signs out there, like bank credit growth is growing. The Fed cutting rates could already be doing what it's intended to do, stimulate the economy, encourage more borrowing, and you could kind of think of credit as fuel for the economy. Looking back in prior recessions, shaded here in the grey, credit's almost always decreasing and quite sharply going into a recession. So that's a good sign that we're seeing a little credit growth here. And no doubt AI and robots is a long-term threat to jobs, but they will also bring about some new jobs as well. No doubt mostly high-skilled labor, but there will be new jobs to help usher in this new era that's going to affect pretty much every industry, not the least robotics. And we got another taste of that today, as headlines for this sector have been increasing of late. The latest today, Chinese tech giant Alibaba up big on news that they're going to integrate NVIDIA's AI development tools for physical AI, including robots and self-driving cars. Quite a pivotal partnership between America's leading tech company and China's leading tech company, as the two governments are still going back and forth with each other over this topic. But the Chinese would have had to sign off on this deal, so I guess that's a good sign, with now two of the world's largest tech companies working together to accelerate physical AI and robots. This in addition to news that they're about to accelerate their own AI spending, planning to open new data centers abroad and unveiling a new AI language model, quickly trying to catch up to the Americans after we did get that big DeepSeek scare earlier this year. Spooked the market for a few weeks there, prompting calls for the end of the American-led AI boom. Ended up being a nothing burger, but the market for sure is taking note of Alibaba here, up 8% today on monster volume, and is going out to a monthly chart. It is well and truly pushed up off that long multi-year base, still well off its 2020 highs after the Chinese government clamped down on them. But no doubt Chinese tech companies are going to play an important role in AI's advancement, the only real competitor to America. But all that wasn't enough to give a bump up for NVIDIA shares today. Similar to that news we got on Oracle yesterday with the new Stargate project. Again, the market kind of gave a muted reaction, and some of these other AI related stocks still trading a little soft, but not too far off highs. Looking at Palantir here, what's still absolutely lighting up are the crypto miners turned GPU landlords. One of the best being Iron, up another 12% today. Like I said yesterday, it was a bit stretched on the chart here, technically overbought. Does look vulnerable to a bit of a pullback, but I'm not complaining at all, as me and my members are up over 180% on this, and I'm still holding long as I use my own trend following system to determine when to exit for all of my stock picks. So no doubt a crazy amount of momentum in these smaller AI infrastructure stocks. Also lighting up there today, Lithium Americas, with the stock doubling. As I've been saying, expect more announcements from the Trump admin seeking to get directly involved in the stock market, backing companies of strategic importance. The White House is seeking an equity stake in Lithium Americas, which is headquartered out of Vancouver, but they're the majority owner of the Thacker Pass mine in northern Nevada. Expected to become one of the largest sources of lithium in North America once it's operational. And we saw this with the Pentagon recently taking a stake in rare earth miner MP Materials. The government's looking to take direct ownership in the mineral supply chain, critical to US interests and future technologies. With lithium the key ingredient for lithium-ion batteries, we've seen a big rally in battery stocks the last few months. This one was kind of largely ignored by the market, still quite small at just 1.4 billion. Monster volume today, 288 million shares. It's going out to the monthly chart. I was actually just talking about this yesterday. The lithium and battery industry just coming off a multi-year bear market, forming a good base pushing up here. And so what the market will be looking for now is what could be next. What are companies out there that could be of strategic importance for the United States? And that's something I'll be researching this week for my next stock pick I'll be giving out to members on Sunday morning, as we've now got the huge tailwind of direct government investment. And before I show you what happened in December 1996 that could be similar to something that just happened yesterday. First, let's just take a quick look at some macro and rates. Fed's restarted their easing cycle. We've already seen the United States 30-year mortgage rate come down, which should help to relieve some pressure on millions of consumers out there. But Treasury Secretary Scott Bessent thinks J-Powell should be going bigger and that he should do a full 1.5 of rate cuts by year end. That would mean we need 2 really big cuts at the October and December meeting, as J-Powell once again is pushing back a little bit on doing more rate cuts, maybe why the market's having a little bit of a pullback, even though Powell now himself is finally admitting what I've been saying all year. Quoted as saying yesterday, we're now collecting a good bit of revenue, $300 or $400 billion a year from tariffs. Who's paying for that? So far, it looks like the middle group, retailers and importers. They're not passing along to consumers that much of the cost. The actual impacts on inflation have been quite modest so far. It's a small amount. And that's because so far this year, it's been equivalent to a $190 billion tax on the US economy, which is on track to do over 30 trillion in GDP this year. In other words, barely a 0.5% fee on the entire economy. And that's why it's likely we're going to continue getting more rate cuts, especially with the government going to replace Jay with someone who's likely to be ultra dovish. And so if we don't have lower rates by May next year, when Jay's set to depart, we almost certainly will after that. Of course, if we don't have any surprise shocks in oil, but if we did, the government would move quickly to address that. What was interesting yesterday was Jay Powell said the stock market appears to be fairly highly valued, which is not really his problem, but nonetheless, it has got many people in finance talking today. I'm seeing it through my social media feed. Surely we've got to have a big correction now because the man at the top said the market's overvalued. He's got to be right. There's charts to back him up that he's right. No doubt, popular valuation metrics are definitely stretched here, like the CAPE ratio, but still not as high as the late 90s. And like I said, valuation is a terrible timing tool in the short run, even though, yes, the returns over the next 10 years for the S&P 500 index and NASDAQ could very well be lower than the past 10 or 15 years. Why it reminded me of December 1996 is because the then Federal Reserve Chairman Alan Greenspan made a similar point with his famous call of the US stock market exhibiting irrational exuberance, causing a wave of selling throughout markets. And again, there was an overriding rhetoric back then as well. Here's an article just after Alan Greenspan made that call on the stock market being overvalued. What goes up must come down. Going on to say, if you have any common sense at all, got to think about getting out before the market crashes. Maybe you're a glutton for punishment. Perhaps you missed all the fun from the 95-96 bull market and whether it's too late to get in. Will the Dow Jones soar like an eagle to 7,000? Greenspan said the market is too high, and he's probably right. There's plenty of reasons to be cautious with our money. And just looking at the monthly chart of the NASDAQ index back then, it's easy to see why that was an overriding rhetoric. There it is, December 1996. The stock market is irrationally exuberant. Prices had more than doubled just over the prior year and a half. However, as I always say, crazy can get crazier because the market actually went on to more than quadruple. In fact, it went up 5x from when Alan Greenspan said the stock market was irrationally exuberant. NASDAQ index went from 820 all the way up to 4816 before finally topping, and then of course having quite a sizable bear market the next couple of years, with a peak to trough of 83%, and many of those hot tech stocks went bankrupt, delisted. If not, even the likes of Amazon was down 90%, even though they were continuing to grow revenues. Valuations just came back down to earth. And so this is definitely a possible scenario the next year or two, thanks to the AI boom. Or did Jay Powell just nail the top? We're getting all these remarkable similarities from the mid-late 90s to nowadays. And like I said, the CAPE ratio still hasn't reached the peak of March 2000, and nothing to say it could go further than that. But it will at some point inevitably end, even if AI revenues keep growing. Nothing can go vertical forever. It will eventually come back down to earth. And there's a look at the NASDAQ monthly index. No doubt been on a roll here, but still hasn't gone crazy vertical yet. And that might actually be needed to give us the blow off top. When it happens, nobody knows for sure, but we very well could be on our way. Looking back at the average of all equity bubbles since 1900, they've typically risen 244%. The Mag 7 currently up 225%. Average decline after the bubble pops, 62%. And just like the late 90s, we do have recession risks there. And it would be, again, different this time if we didn't get one in the next couple of years. As a lot of models suggest, it's almost certain. But again, you don't have to have your whole portfolio in US mega cap tech stocks, just like you didn't have to back in early 2000. There were plenty of markets and sectors that finished 2000 and 2001 higher. In fact, there was an early commodity boom back then, along with emerging markets that had a great bull run all the way up into 07, 08. And even this year, in the midst of the AI tech boom. We've got a very robust international bull market. Dozens of countries up healthy double digits year to date. And these are all US listed ETFs. And it could still be early days for international markets. Looking at the all world index excluding America, just broken out this year from a 17-year base. The old saying in technical analysis, the bigger the base, the higher the space. And that's why I think it's a great time to be a global ETF investor. We've got this incredible amount of global momentum, allowing us to achieve really good returns with a globally diversified portfolio, taking away that risk, taking away that uncertainty, while still being able to participate in the American tech boom, even if it does go on for a few more years. Countries like Singapore doing well, but we've also got a huge amount of new ETFs hitting the market every day. Recently, crypto Dogecoin, now under an ETF wrapper, ticker symbol Doge, giving us investors a lot more options of different exposure. In addition to new strategy funds like the Smart Earnings Growth 30 ETF, using a proprietary ranking process, identifying the top 40% of large cap companies based on sales growth, new products, and quarter over quarter earnings. Another one out from the Smart Fund Manager, the Trend 25, again using a quantitative ranking process based on momentum and valuations. And these strategy funds are also what's known as factor investing, looking at the key investment factors: momentum, quality, growth, size, volatility, which is also known as smart beta, something I've extensively studied for over 10 years now. And again, it just provides us with so much more investment option. Another new one, although a little illiquid at this stage, the Wisdom Tree Geo Alpha Opportunities Fund. Interesting strategy of tracking companies around the world that are expected to benefit from geopolitical shifts, including geopolitical events, companies benefiting from supply chain changes, tax policies, defense spending, alliances, or trade and tariff policies. And more research houses coming out with their own ETFs as well. Hedgeye, Quality Growth ETF, Horizon Managed Risk ETF, again another proprietary strategy with a risk overlay using options to reduce drawdowns. And the Dana Concentrated Dividend ETF, again another smart beta fund focused on dividend paying stocks, weighted according to investment factors. So I think the future's looking bright for us ETF investors. And just looking at a few of the best performing ETFs today, no surprise to see the Global X Lithium and Battery Tech Fund doing really well on the back of that new government announcement of investing in Lithium Americas, lighting up the whole critical minerals sector. Fund I've mentioned a lot this year, the Rare Earth and Strategic Metals, REMX, once again breaking out to highs up 6.4%. And that's the thing with ETFs. A lot of people think because it's a fund they can't deliver big returns, whereas that's not true at all. They can not only deliver similar returns to stocks, but with far less risk. Copper miners also having a big day on volume here breaking out. And the CQQQ, China Technology ETF, big volume, momentum up with thrust signal as China continues to perform well of late. Also performing well today that I mentioned yesterday, energy starting to perk up. Looking at the equal weighted energy ETF, once again, big volume breaking out to a new multi-month high. Sector that's really been lagging behind appears to be gathering some momentum here, potentially on geopolitical concerns. And so I've studied momentum investing for about 10 years now. And in fact, I've been running a unique momentum strategy in one of my long-term accounts for almost the past 3 years. I was previously invested in my fund manager's default balanced fund, a diversified portfolio of global assets. And it's not that it's done so bad. It's averaged 7.78% per annum over the last 3 years. I've just been able to do a lot better with a simple monthly rebalancing momentum strategy, helping to grow one of my accounts by 18.29% per annum over the last 3 years, delivering a 68% return, far better than all the other fund options, and only with 10 minutes work per month. And those returns were achieved with a globally diversified portfolio that not only grows my wealth, but also protects it. And that's just as important to me as other returns, because I know the S&P 500 and NASDAQ have been performing very well these past few years. However, the next 10 years is likely to look different, and I believe many investors have become anchored to these indices. And like we've seen in prior bubbles, most of them inevitably end up getting wiped out. But I strongly believe my global all-weather ETF investing strategy guards against that inevitability as it naturally rotates out of underperforming assets into what's always holding up the best while staying very diversified. And these are investing principles I use in all of my strategies. I'm really big on diversification and risk control. Even in my stock picks, using a trend following strategy on small caps, the portfolio does have the ability to go partially or all in cash. And in fact, it did go partially in cash throughout the tariff tantrum, waited to markets to stabilize before reinvesting the cash back in. And that proved to work out really well, with my returns more than double the benchmark small cap index since I started the stock pick service in June last year. And even looking at simple returns, the small cap index is up a bit over 9% in the last year year and a quarter. And even though I buy $500 of a new stock every Monday, I still delivered a 24% simple return on the total cash invested, even though that was spread out over the last year and a quarter. And that dollar cost averaging is what creates this smooth equity curve, making it very easy to stay invested. And all of these results are 100% verifiable. I post records straight from my brokerage account in the private members area. Anybody can double check these performance stats. I stand by them 100%. And again, that's something you won't find anyone else doing. Similar deal for my options trading chat room. In the last hour of US market close, I share with my members in real time exactly what options trades I'm making with screenshots straight from my brokerage account the minute after I've made them, or sharing what the profit or loss from every trade ends up being. Again, these results can be verified 100% to back up my stats here. Since I started the Market Makers Kit and options trading chat room back in May, I've made 179 trades, 103 winners, with a win rate of 57.5% and a net profit of $14,823 US dollars, never using more than $50,000 worth of margin. And some people might just think, well, I got lucky buying the dip, being bullish in this recovery. But as my options members know, I make plenty of bearish trades as well. And in fact, I always keep my options portfolio what's known as delta neutral. And I teach that inside the options members area with some training videos. A lot of the time, my portfolio is either delta neutral or slightly net long or slightly net short. At the moment, I've actually got it slightly net short, meaning I can profit when the market comes down. And in fact, as my option members will remember, one of our most profitable days so far was on the 1st of August. The market came off a bit, but like I said, I control risk really tight, so we can profit no matter where the market goes. And again, that can help insulate against bear markets. And in fact, there's more opportunities to trade options when volatility spikes, which it hasn't done ever since I started the service. And I actually did really well coming out of the April spike, selling volatility, like I was sharing with you guys on here, shorting VXX using options. And so again, it's a good way to diversify instead of being all in on the S&P or NASDAQ. Trading options allows us to profit in volatile bear markets as well. And as my members know, I use my custom trading view indicators to help me identify trades and interpret the market. And so if you'd like to get access to not only my new ETF portfolio opening tomorrow, but also my stock picks, options chat room, and 30 custom trading view indicators, then keep an eye on your inbox if you're on my email list, or come back to this channel, Click Capital, tomorrow, and I'll be sharing the 40% discount coupon code available for launch week only. And this will be your best opportunity to save big on the new ETF portfolio service or some new package deals that'll be on my site tomorrow, including all the other services. And good news for UK and European investors. One of my members messaged me today and said UK and European investors can't access US listed ETFs only if the broker has offices inside Europe, and that they can actually access US listed ETFs with brokers like Tasty Trade or Tiger Brokers, both of whom I actually trade with as well. So again, please do your own research. This is not financial advice. I'm just passing on some information that was handed to me today. But regardless, if you're in the United Kingdom or Europe, you can still get 40% off a package deal that includes my stock picks and options trading chat room, along with the indicators as well, if you aren't able to access the ETF portfolio service, which would be a shame if you couldn't, because it really is one of my best strategies that I plan on sticking to for literally the rest of my life. And just to share with you guys, my own personal wealth goal, I do have a few short and medium term financial goals, but my ultimate long-term financial goal is to be worth more than $100 million by the time I hit the retirement age of 65. And I strongly believe that I'll do that, as I've done the calculations, and if I keep compounding the way I have been for a few years now, in addition to consistent monthly contributions, I will comfortably hit this goal of mine. And my ETF portfolio is going to play an important role in me achieving this goal, as like I said, I'll be making monthly contributions to it until I hit age 65, which is around 25 years away for me. And so I invite you to join me on this journey of wealth building and witness firsthand my ups and downs along the way, all of which I'll share with you in real time with monthly reports and access to my account performance, with my brokerage records uploaded to the members section for you to see. This is transparent wealth building at its finest, which again is something you won't find anywhere else. So keep an eye on your inbox if you're on my email list. Otherwise, come back to the Click Capital channel tomorrow, and in the daily market review, I'll be sharing the 40% discount coupon code so you can jump on board the new ETF portfolio that I'll be starting on the 1st of October. And you can also save big on a package deal if you also want to get access to my weekly stock picks, daily options trading chat room, and 30 custom trading view indicators as well. And this is the cheapest I'll ever be offering my premium services for during launch week only. So I'm super excited to start this. I think it's going to be a great journey. We've got a global bull market out there, momentum everywhere, and multiple asset classes. The portfolio's been on fire this month, and it could still be early days. So stay locked in here with Click Capital, and this time tomorrow, you can get access. Thanks very much for watching. My name's Jared, and I'll see you back here again this time tomorrow. Cheers.